Now we'll deal with chapter number 8, financial regulatory aspects of solvency margin and investments. We will discuss reserves about premiums and claims and insurance accounting. This will be two main topics for discussion. Reserves. What are reserves? Without reserves, insurance company cannot survive. It is providing money for future use. Now, very simply speaking, reserves is like savings. Out of our income, we make some saving to be used for future contingency. So, similarly, insurance companies also have to provide for some money for future contingencies. These are called reserves. Some reserves are compulsory, statutory, or under IRDA regulations required to be made. Some reserves may be voluntary. Insurance company make on their own. These reserves will affect the working of insurance companies. And if statutory reserves are not maintained, IRDA may direct insurance companies to maintain reserves, and if they are unable to maintain the reserves, IRDA is having power to suspend their license, to even cancel their license. Why? Because not maintaining proper reserves will hamper the working of insurance company. It may happen that because of insufficient reserves, whenever claims are there, insurance companies do not have money to pay. In India, it has not happened, but after collapse of Twin Tower or lodging of asbestos claims in 1993 and 94, many companies went bankrupt because they had not provided for contingencies by way of reserves. Same thing happened in Japan some years ago. Life companies promised big returns, and because of lesser reserves, when the time of payment came, they could not pay and went out of business. So, any insurance company going bankrupt affects the financial working of clients, it affects the working of economy. So, reserves are very, very important. If you don't have savings, what can happen? Same thing can happen to insurance companies if they don't maintain proper reserves. Insurance is specialized industry. There, costs are delayed and uncertain. Why costs are delayed? Certain costs can be estimated like staff salary or administrative expenses. But in any insurance company, main cost is of payment of claim. Claim will arise in future. At that time, what will be the cost of handling the claim cannot be decided now. So for that we have to provide for. So costs like legal fees etc. will also change, survey fees etc. they may change. So for that you have to provide for. So they are delayed and uncertain. Why uncertain? Because you don't know when they will be incurred, how much will be incurred. Now case may be decided after 20 years. So what will be legal fees after 20 years? You don't know. Secondly, for how many years legal fees are to be incurred on particular case? You don't know, because you can't decide for how many years the claim will be fought in the court of law. So like that, costs are delayed and uncertain. In case of normal claims also, what will be the amount payable? That is uncertain. You cannot say that full sum assured will be payable in each policy. If full sum assured is to be paid, then you cannot run the business successfully. Okay. So that is to be kept in mind while deciding reserve. Large losses take time to settle. If losses are very large, big factory is burnt, then to rebuild that, it will take longer time. So in one particular year, you cannot decide what will be the provision for claims. You have to decide over particular years how much you will be paying for that claim. So you have to provide for future by way of reserves. Okay, that we'll see slightly later on in detail. So management of reserves is very important function of insurance company. It affects profitability, it affects society, it affects economy in general. Most important reserves are technical reserves, and they are related to reserve for unexpired risks, reserve for incurred but not reported claims, they are called IBNR claims, reserves for outstanding claims, fluctuation reserves. All these are reserves pertaining to claims and policies when we talk about unexpired risks. Reserve for unexpired risks pertains to the policies which are running on date of closing of the account. They also relate to premium which is earned less but may give rise to bigger claims. We will see slightly in detailed format slightly later. Reserve for incurred but not reported claims are those claims which are not come to insurance company but certain events have occurred, like there is bomb blast in area where insurance company has insured the property, but insurance company is not sure whether the claim will be lodged on them or not, because client's property may have been affected, may not have been affected, and on the date of closing of account it is not certain that claim is there or no. So that is called incurred but not reported claim. There is possibility of claim coming, but it has not come. Reserve for outstanding claims, claims which are going on but the amount is not final, not decided. So provision is to be made for that. Fluctuation reserves. Insurance company create these reserves for the situations where the judgment go wrong. They have judged that claims payable will be X, but final claims come much higher. So for that they may provide for fluctuation reserves, because time span for deciding claims may be longer. For example, third party claims under motor, it may take many years to decide. So in that case, fluctuation reserves are also provided for. Now what will happen if reserves are not properly made? If under reserving is there, lesser than required amount is shown as outstanding. Suppose claim is likely to be 1 crore, but insurance company shows in books 50 lakhs, then it is under provisioning. So what will happen? Instead of 1 crore, insurance company has provided 50 lakhs. So its profit is increased by 50 lakhs. It gives wrong picture of working of insurance company. It will increase profitability temporarily. When actual claim is paid, it is paid for 1 crore. So in that particular year, profitability will go down. So such practice is not advisable, not encouraged by all concerned. Then over reserving is also not good. If client has lost claim for 50 lakhs, insurance company reserves for 1 crore, then profit is understated. So understatement of profit is also not good. So both ways, whether under provisioning, over provisioning, is not advisable. Correct provisioning as far as possible is to be made, and for that management of reserve is slightly technical. Now what is reserve for unexpired risks? What type of reserves are to be made? Mainly they are accounting reserves, technical reserves we saw, then unexpired premiums. What are unexpired premiums? We have issued policy for 1 year. On the date of balance sheet, full policy has not run. So For balance period, we have to provide. That is unexpired reserve. Similarly, under soft market, premium is taken less, but actual claim is likely. So market has become hard, or insurance company expects that claims are going to be much more than they can provide for that. Then asset liability reserves. Assets and liabilities are to be properly managed, and particularly liabilities. So for other types of liabilities other than claims and premiums, insurance companies also have to provide for certain reserves. The various stakeholders in company are concerned with reserves. Who are stakeholders? Whoever is affected by working of insurance company. There are many people, many agencies. They may be investors, policyholders. We'll see in detail about stakeholders. Shareholders. If members of public have invested money, then they are stakeholders. So they are concerned with working of company because their profitability, their dividend is affected by working of company. So ledger reserving will affect the stability of the company in the long run, and if company is closing down, then stakeholders will lose their money, so they are concerned. Over reserving will reduce their dividend. Lesser profit is shown, so profit available for them is less. So shareholders are stakeholders. The government and regulator, they are concerned because they have to see the interest of customers. For example, IRDA. If proposals are not made, all of a sudden companies goes bankrupt, then all those people whose claims are outstanding will be affected financially. So regulators are concerned about proper reserves. Then insurance market, if reserves are not shown properly, claim ratio figures will be misguiding, and market will not charging premium properly, which wherever the claims are not wherever certain portfolios are not profitable, if proper reserves are not made, they will be shown profitable, and market will be misguided, and they may charge lesser premium. So if true position is not shown, then market is also affected, insurance market. Government is affected because if proper profits are not shown in the accounts, by transferring more amount to the reserves, profit will be less, so tax collection will be less for the government. So tax collector is also affected, government is affected. So proper reserving is desirable. Underwriters, because they will not be knowing the cost of the claim. If claim outstanding is less, the branch which they feel is profitable may not turn out to be profitable. Or branch which may think is making huge losses may not be making huge losses in reality, so their underwriting will go haywire. So proper reserving is necessary for that proper claims records are to be maintained and updated from time to time. So insurance company management is also worried, the board of directors, because they are concerned about profitability. Insurance is not for social service, it is commercial activity. So in long term, every insurance company should make profits. So profitability out of working of insurance companies also necessary for insurance company management. So true picture is to be given to them by making correct reserves. They are also concerned about trends in market, trends in working of the company, why profitability has gone down, etc. is also to be reported to them correctly, so that they can suggest corrective measures and take corrective actions on working of the company. Early warning of future problems are coming to their notice, they can take corrective actions. For example, if market is very soft and premiums are being charged much less than the cost of the claims, it comes to knowledge of board of directors in time, they can issue directives of charging minimum premium irrespective of competition in the market. So some companies, wherever they report to their higher authorities about working, they have issued directions that certain branches of business is not to be underwritten, certain type of business is to be underwritten with a minimum premiums, etc. Similarly, market also may behave in particular fashion. When higher claims are reported under flood, etc., companies may decide not to charge lesser than certain premium. That can also happen where competition is fierce in the market. Type of technical reserves, we will see slightly detailed. Premium reserves, generally there are two types, mainly for unearned premium reserves. Unearned premium is premium which is not earned on the date of closing of the accounts. Generally, general insurance policies are for 1 year. So on the date of closing of accounts, every policy will not expire. A policy is taken, say, on 1st June and accounts are closed on 31st March. Then from 1st April till 31st May of next year, the premium is not earned. So for that, some reserve is to be made. Claim may come during that time. In practice, insurance companies don't calculate expiry period of every policy. It is humanly not possible, even with the help of computers, because cases like marine, risk will over only when the transit is over. So in that case, they make provision for reserve on some ad hoc basis, some 50% of premium, etc. Unexpected risk reserve is to make adjustment for soft market. Though this is not good practice, some insurance companies are following this. It happens when in soft market, when premium received is less, and subsequently at the time of closing of account, they come to know that the claims are likely to be much more than their expectation. So they provide unexpected risk reserve additionally. The claims reserve are open claims. Two types. You can classify under three types also. Open claims are for reported claims, claims which have been informed to the insurance company. They have received the claims, they are in process. So during currency of the claims procedure, they can adjust the outstanding claims depending upon surveyor's indication or picture becoming more clearer. Suppose claim was lodged initially 1 crore rupees under property claim, fire claim. At the time of closing of the accounts, surveyor has intimated that claim is not likely to exceed 55 lakhs. So claim is now to be kept outstanding for 55 lakhs and not for 1 crore. Initially, when amount is not known, it may have been provided for 1 crore. So like that, open claims are to be reserved on day-to-day basis. Then IBNR, incurred but not reported. The event has occurred, but you are not aware what will be the quantum of claim. So in that case, insurance companies provide on basis of their past experience or on some ad hoc basis. Then IBNER, some insurance companies make provision for this type also, incurred, not reported, enough, not provided. So when claim is provided lesser, this type of claims, once again adjustment is to be made. They call IBNER, not enough reserved. So that is NER. But that practice is not good practice. But in totality, if overall reserves are made properly, then it may not create any problem. Then some insurance companies provide claim equalization reserves, like buffer. They may feel that whatever provisions they have made, they may go wrong. So for that, some claim equalization reserves fund is created. When good years are there, profits are sufficient or more than expected, some amount can be transferred to this fund, and in bad years, when profits are less, amount can be taken out of this fund. So for that, controls are required because they take into consideration cyclic fluctuation, catastrophic losses like earthquake, flood, etc. So normal reserves in catastrophic losses will not be sufficient. So for that, if claim equalization reserves are provided, then they will help and companies working may remain stable. Other reserves are of other type. It depends upon type of losses expected, like earthquake, fire and storm, tempest, etc., terrorism. So insurance companies may provide special reserves for that. Investment reserves. Now investment is more important, one of important aspect of insurance companies working, because in practice we see main income to insurance companies comes out of investments. Premium is collected today, claims are to be paid in future. So the difference between today and future, money will lie with the insurance company. And if insurance company keeps money idle, it is of no use. So this money is invested in securities and stocks and other investments to generate profits and income. Instead of keeping money idle, it is invested. So what is investment profit is more, most of the times, than what is called underwriting profit. Underwriting profit is out of pure insurance operations, receiving premium, paying the claims. So most of the times, whatever premium is received in certain branches, at least, like medical insurance or motor insurance, payout is much more. In spite of that, health insurance companies are surviving. In future, if any pure motor insurance company comes, it will also survive because of support out of investment income. So investment reserves are made for fluctuation in investment income or investments value going down. Investments are important, so IRDA is having control over investments also. Bad debt reserves. Generally, these type of reserves are not necessary for pure insurance working in India, because in insurance, bad debts will not arise because of 64 VB of Insurance Act and Indian insurance market practice. We don't grant cover without receipt of premium in advance. So if premium is not received in advance, it may become bad debt. But non-insurance activity, if some credit is given, then bad debt reserve is to be provided for that. Reserve for taxes, government taxes, income tax taxes, service tax taxes, etc. be made under overvaluation of assets is accounting reserve, that is also required to be made. Now what is the process? As we saw that reserving requires some management, knowledge, and sometimes expertise. So for small and simple claims, much expertise is not required. Past experience can be considered and can be adjusted for inflation, etc. For example, if you are providing for a particular claim for, say, heart surgery, bypass, how much amount is to be provided outstanding, you can know. If a person has handled few claims, he will be able to provide. So small claims, past experience, averaging out, average medical claims come say around 50,000, then we may provide 50,000, like that. And for adjustment, some adjustment can be made for inflation, etc. So that is simple method. But for large and complex claims, this method is not useful. So experts' opinions are taken, their estimates are to be worked out, judgments are to be, court judgments, etc. also to be considered, because this is very subjective matter. Sometimes actuarial help also can be taken to decide the outstanding claim provisions. It should not go haywire. A minor calculation error will affect amount-wise very big. So for large and complex claims, the process is slightly detailed and elaborate. Then whatever provisions are made, they should be reviewed periodically as ongoing process, particularly in the case of liability matters, third-party liabilities, and large claims where claims are not settled immediately, like loss of profit claims or big fire claims where reinstatement is going to take longer time, or general average claims where matter is decided over 4 to 5 years or sometimes even 10 years, or legal matters where judgments are going to take longer period. So in that case, review is to be made periodically. Open claims, claims which are in process, real-time review means every week, fortnightly or monthly, outstanding provision is to be correctly reviewed. Then actuarial involvement is required in case of major claims, and IRDAI regulations say that they have to certify the provisions made by insurance company. So what they do, they bring data together, break it down into subclasses, review it, refine it, build it in provisions for incurred but not reported claims. Then they construct reserves out of that, what should be reserves, that they decide depending upon some actual exercises. We are not going to detail into these exercises. Sometimes subclasses are also formed, but subclasses should be homogeneous. They should not be too big or too small. Otherwise, if they are too big, then difficult to decide what should be ideal premium depending upon the claim experience, or too small, then at the time of deciding premium, we cannot apply the law of large numbers because numbers are very small. So the class should be of ideal size and homogeneous as far as possible. There are certain challenges of subclasses and reserves. Past experience may not be always reliable because business environment is changing. For example, 3-4 years before, whatever was technology in case of medical science and whatever expenses were there, expertise available, etc., now has changed considerably. High-tech surgery, robotic surgery, all these were not there few years before. So cost, etc., was very less. Now it has increased considerably. So while providing reserve, you cannot go over past experience alone. Then long tail cases, like liability matter going on for many years. Whatever was court trends earlier now may change. Few years before, courts were avoiding lesser amounts by way of motor third party judgments. Now amounts have increased. So all that also to be considered. Now marine general average claims. Earlier 5-10% of cargo value provision was enough. Now in smaller matters 35-40% also may not be sufficient. Then in some branches, there may be very little past claim experience, like director and officer liabilities. That we don't know, because past claim experience in India is not considerable, so we cannot go by past claims in director and officer's liability. So what is the remedy? Study the provisions deeply, clearly, and decide. Then adjustment also is to be made to the claims in case of reinstatement value, because in reinstatement value policies, claims will be settled on the value on the date of reinstatement and not date of loss. So for that, adjustment is to be made. Law, as we saw, that third party motor liabilities, legal trends are changing, awards are changing. Earlier 50 lakhs, 1 lakh, 50,000, 1 lakh, etc. was considered reasonable amounts for medical expenses. Now that may not be reasonable in mega cities or metropolitan cities. So all that is to be considered. Generally, insurance companies prepare checklists and take into consideration the various aspects of providing for reserves. Investment, we saw that it is very important aspect of working of insurance companies. There are many theories of investment, but two are very popular. One is called modern portfolio theory. In that, any investment is not taken singly. Suppose money is invested in stock exchange. So one single company will not be considered. Certain selected groups are decided, like small cap, medium capital companies or large capital companies, and within those groups the investment decisions are taken, not company wise but group wise. So one company may be profitable, other may not be profitable, or sector wise, steel sector, power sector, like that, or government sector. So all those things are considered. Portfolio with higher return and lower income is also considered while deciding MPT theory. Similarly, asset and liability management theory is also there. In that process by which institution manages its own balance sheet on continuous basis, they will decide about assets, how many assets to be purchased, what amounts to be spent, liabilities, how to restrict liabilities, how to provide for that. So generally, to decide on investments, modern portfolio theory and asset liability management theory are involved. We are not going to details about this because in our subject these are not very important for the time being. Sorry. IRDA has issued regulations for investments, and as per that, these are guidelines for investment of insurance companies' income, reserves in these percentages. These are to be amended by IRDA from time to time by way of regulations, and every company has to file return along with balance sheet about their investments in various securities. So central government securities 20%, government or other guaranteed securities 30%, like that. Approved securities, non-approved securities, certain classifications have been made by IRDA, and they have framed investment regulations for life companies, non-life companies. So those are to be followed by insurance companies. If these are not followed, then IRDA can take action by way of imposing fine or cancelling or suspending their licenses also. Then next topic is insurance accounting. Insurance company, like any other company, is a company. So accounting should be as per company law provisions. So they have to maintain balance sheet, profit and loss account, etc. Plus they have to maintain certain other accounts which are typical to insurance working. So revenue accounts, income and expenditure account, then classification of receipt of premium under various acts, various branches like in life, what is out of annuities and others and other policies. In general, what premium under fire branch, under marine, under miscellaneous branch, etc. Then they have to provide for liabilities and reserve for unexpired risks. This is typical to working of insurance companies. Then acquisition cost of any asset is to be diminished over a period of time. Then claims is very important. Outstanding claims, incurred but not reported claims, incurred not equally provided claims, etc. Then plus minus adjustment for claims. Salvage is also very important in insurance working. So provision for that also is to be made in the claims. Provision for salvage will reduce the amount of the claim. So profitability may increase. So it is also important aspect. The investments made by insurance company in various type of securities, real estate, derivatives, unlisted investments, all this should be done as per IRDA regulations. So insurance accounting should reflect all this, and returns to be filed to IRDA. IRDA has devised formats for this under various regulations. So as far as loans are there, they are to be on historical basis. Historical means the original cost. Whatever loans is given, that should be as per the amount of loan, not to be adjusted for other aspects like interest, etc. So loans, as far as the insurance company is concerned, they are not giving loan in normal course of business, but it can be loans to employees for housing loan, etc. Catastrophic reserves are to be made for cases like big claims, but those are to be made for as per IRDA norms. Catastrophic claims are claims for earthquake or flood or terrorism, etc. As far as the insurance company is concerned, important accounting functions are accounting for premium, commission and brokerage accounting, commission or brokerage paid, outstanding, claims accounting, claims paid, claims outstanding, incurred but not reported claims, then reserve for claims, accounting for expenses of management, co-insurance accounting, reinsurance accounting. These are to be reflected in insurance accounts. Investment accounting as per IRDA norms. Accounting of foreign operations. If insurance company is having foreign operations other than reinsurance, like having a branch in foreign country, then those accounts also should be considered while presenting accounting of any particular company. So today we saw in this topic reserves, technical reserves for premiums, claims and other reserves, reserving process for small claims, big claims, investment theories, MPT and asset liability theory, very briefly, IRDA regulations 2004 about investments and accounting, then insurance accounting, general accounting plus insurance specific provisions, IRDA guidelines, and accounting module which is required to be followed by all insurance companies, suggested by IRDA. At the same time, it is important to follow IRDA module because if somebody wants to compare working of two insurance companies, at the same time it can be compared. So that was today's discussion. Thank you.